Thank you so much for joining us today, everyone. I'm Lauren Glover. I'm a member of the marketing team at TrueAccord, and this is Debt Collections Compliance under the Biden administration. I'm going to kick us off today by giving a quick overview of what you can expect from today, and then I'm going to pass the mic right over to our expert speakers. I know you're most excited to be hearing from them. So, as you all know, the Biden administration has signaled a real incoming sea change at the Consumer Financial Protection Bureau, one that is going to include a stronger focus on debt collection practices, as well as more relief for consumers who've been affected by COVID-19. So in today's webinar, we're really going to dissect what this new environment means for lending organizations, and we're talking about lending organizations of all kinds. And we're going to be sharing thoughts on how lenders from various verticals can build more compliant, but as well as more consumer-friendly collections practices this year. So our speakers today, I am so excited to introduce them. We're joined by Dan Kwan, who's the managing partner of Bank Street Advisory, as well as this former senior advisor to the director of the Consumer Financial Protection Bureau, as well as Ohad Samet, the co-founder and CEO of TrueAccord, the leading digital-first debt collection solution provider. So here's a quick look at our agenda before I hand it over to the speakers. We're going to be starting off with an introduction to this current moment by Ohad, who's going to give us a real lay of the land. Then we're going to transition into a fireside chat where Ohad and Dan together are going to share their insights. We'll digest that fireside chat into a lightning round of questions where we'll get some quick actionable insights for all of you. And then we'll do a quick Q&A. So brief note of housekeeping. As you think of questions during today's session, feel free to use either the chat box or the Q&A feature on Zoom, which is located in the menu along the bottom part of your Zoom window. So let's go and get going with this introductory section to this changing regulatory environment. So when we were putting together today's webinar, something we noticed was that there were people, all of you today, our audience is from a really diverse set of verticals. We have people from healthcare, education, fintech, credit unions, banking, and more. And so we were really thinking, what do all of you have in common? And the answer is pretty clear. You are all likely working with consumers who have been really hurt financially this past year, who are likely facing debt, and you are trying to find innovative solutions to help them while also remaining compliant in a changing regulatory environment. So today's webinar is really going to be about that tension between, how are we staying compliant? How are we helping consumers? How are we finding answers? So Ohad, given this current moment, I'm going to turn it over to you to share your thoughts on what this current moment means in terms of consumer debt, fintech innovation, changing regulations. So you're an industry leader in both fintech and collections. What headlines are you watching these days and what's on your mind?
Yeah, good segue. So hi, everyone. It's been, to say the least, it's been a weird year for many of us on a personal level and a professional level, with multiple stimulus and stimuli, I guess, and with shelter in place, people not spending, we've seen a reduction in credit card balances. We've actually seen a reduction in defaults and charged off debt because consumers had more money to pay down debt and they actually delevered. But we're now seeing that trend reverse as people are getting vaccinated, getting out, starting to really purchase more and spend more time, more money on leisure and other activities. We've also seen incredible resurgence or growth in fintech, in new segments like trading, in buy now, pay later products that serve as an alternative to credit cards and more traditional credit lines, and also call it closer to subprime lending, the type of products that you would expect to see when the interest rates are low and the banks are tightening their credit policies. So the mix has changed. Consumers' approach to debt and their available savings have changed. And honestly, I don't think a lot is burning right now. I think we're all preparing for the second half of this year and definitely for next year when consumer spending normalizes, when credit balances normalize, and there's going to be a lot of activity, just making sure that we service accounts effectively and keep consumers current, and of course work with those that can't pay their debt. The other interesting element here is that We're seeing, of course, a new administration, and with that new administration, we're seeing a lot of activity on the federal and also on the state level. On the state level, we see activity from the DFS, Department of Financial Services in New York. We're also seeing a lot of activity from the newly established, newly named Department of Financial Protection and Innovation in California, two large states that are leading the charge a lot of the times and kind of dictating the agenda for other states with their own regulation. And we've seen a CFPB that even under the acting director has been more active and more vocal. Two examples from the last 2 weeks. One, the latest memo to mortgage servicers to prepare in advance for potential relief for consumers as the ban on evictions is set to expire around September, to make sure that there are no unnecessary evictions. And just landed in my inbox 5 minutes ago, the CFPB is proposing to delay the effective date of the new debt collection regulation by 60 days. So just a lot of activity and a lot of uncertainty. And I would say, and Dan and I will talk about that a little bit more, unprecedented activity and proactivity from the financial regulator, pointing at potential problem areas and asking players to align. Now, we started this company 7 years ago. TrueAccord offers machine learning-based, digital-first and mobile-first debt collection and recovery solutions, early stage and late stage, white label and branded. And the idea was that we needed to lean more on consumer choice in channels, in time of communication, in payment options. And we believe that that was going to pay off in terms of results, but also in consumer preference, brand protection, and so on. That's really played out. What I'm seeing, and this would be an interesting topic for discussion for all of us, is that the expectations from the regulators are evolving. And if the new channels, new technologies, and better service to consumers have already been codified in some of those new debt collection rules that are coming, now we're starting to hear the regulators expecting lenders to think about consumers in debt or consumers that are going to be in to fall onto hard times as still their customers, ones that they need to take care of. Now, I don't know if that's going to end up being an actual regulation, but it's definitely getting a lot more attention from a regulator that in the Obama years has been very active, and under the Biden administration, we'll hear Dan's opinion, but I'm sure is not going to be very passive. So that's something for all of us to pay attention to, right? The benefit of consumers and how we treat consumers when they are in debt. It's not only about technology anymore. It's about user experience, net promoter score, how we help them get out of debt and stay out of debt. That to me is a fascinating development, and one that I'm looking forward to unpacking with partners, with clients, and with the marketplace in general in the coming year.
Great.
Back to you, Lauren.
Thank you, Ohad. That was really, really fascinating. So let's transition to today's fireside chat. Here's a fireplace to get us going. So thank you again, Ohad. I want to introduce our special guest, Dan Kwan. As I mentioned at the start of today's session, Dan is the managing partner of Bank Street Advisory and former senior advisor to the director at the Consumer Financial Protection Bureau. Dan led its fintech office, Project Catalyst, which was the first of its kind in the world and inspired regulatory agencies across the globe to set up dedicated fintech innovation hubs. Dan is a nationally recognized fintech thought leader and serves as a bridge between Silicon Valley and the Beltway. And Dan, we are honored to have you here today. Ohad, I'm going to hand it over to you to start the conversation.
Great. So Dan, a lot to talk about. Maybe kick us off. Good to see you too. Maybe kick us off, talk a little bit about Project Catalyst. I think in the narrow sense of how you handle it, and then maybe in the broader sense about how has the model of cooperation between government and industry changed over the years. I can say from our perspective, it's been an incredible program to be participated to the extent that we could. There was a lot of interest from the CFPB side to learn and then to incorporate as it saw fit into regulation. What did that look like from your perspective?
Sure. Again, thank you very much, Ohad and Lauren, for inviting me here. So I think when we started this Project Catalyst initiative, there was no such thing as communication between the emerging fintech sector and the government agencies. So frankly, living in DC, that was a big bubble, probably similar to the big bubble the folks in San Francisco also live in. So there was little communication, if or very little or no communication at all. So that was really the first thing we did. And now, talking to regulators has become a norm. So every agency today, including those who are, probably a little bit more reluctant or more conservative, they also have innovation offices. So I think that's really the first barrier we broke. The second thing we were trying to do was really thinking about, enforcement obviously is a very effective tool to police, the industry, to make sure bad actors are off the street. But enforcement cannot really bring good actors. Ultimately, you need good companies to serve consumers, right? So as much as we do not like certain practices, but at the end of the day, consumers need to be served, especially those vulnerable, underserved consumers. So we're thinking maybe, through a innovation office, we can promote better practices, better products, or discover better products. The third thing was really about what were the things that the regulations were lagging behind that really prevented emerging technologies, emerging new business models that can better serve consumers, but at the same time, they could pose unknown risks. And I think, if you ask me what were the proudest moments of my tenure at the CIPB in terms of the things that I helped facilitate or accomplish, the first thing that really came to my mind was really open banking or open data access.
Right.
That my office was the first office really in DC to believe that this was the most effective equalizer in terms of democratizing financial services. And then another thing that was really, I'm really proud of was to help the earned wage access industry to really grow and blossom. And back in my days, very few companies doing this. Now it has become a trend, and a lot of companies that are offering other financial services, they also enter earned wage access to provide a opportunity for folks to access their wages before they're getting paid at a much lower cost. Of course, there are still problems, but I think this is really a promising trend.
So there's definitely been an evolution from, like you said, in the early days of the CFPB, regulation through enforcement. That was kind of the sentiment, right? Into different models for cooperating, listening to the industry, even some no action letters that have evolved over the years, and up to lately the letter of understanding or memorandum, I'm not sure, but exactly language from the DFPI in California to the earned wage access industry. How would you say this was actually kind of points on a linear graph, or was there a back and forth and kind of an evolution, one step forward, two step backwards in that relationship between industry and regulators?
I think it's probably both. I think there was definitely some kind of definitely there was a natural involvement. Initially, every agency only wanted to listen. They didn't want to opine. And I think there was this need, and frankly, to even my former boss, Director Cordray, he would say, taking no stance or staying silent is also means the regulatory agency is taking a position, right? So silence is not the answer, and obviously for regulatory agencies, being silent is always a safe way for them to deal with things, especially when the things are unknown, right? That's regulation is really about something certain, but banking is about uncertainty. So regulators are by nature and by design, they are risk averse. So I think the invention of sandbox by the UK's FCA and the no action letters issued by the CIPB, and the first of which was issued actually when I was there, I was in charge of that. I think that shows a natural progression. But at the same time, I think obviously probably in the last couple of years we saw this more of a deregulatory environment where agencies were more willing to issue those kind of letters in terms of number, and we probably will see some kind of a slowdown, or if not full stop, in the next couple of years. But that doesn't mean the agency is not going to is going to disengage with the fintech sector. That just means they're probably going to take a different approach. And I think listening, communication, talking will still be there. And I think more importantly, and I've argued in the past in some of the op-eds that I wrote, it is really not about issuing the number of, it's really not about the number of letters you issue or sandboxes you give. It's really about how you can incorporate these learnings or listening or talking into actual policies or regulations that can, at the end of the day, affect the industry positively and broadly.
Yeah. Yeah, and when I think about this new CFPB and under the Biden administration, of course, we all go back to the CFPB under Director Cordray and in the Obama administration, right? We're not thinking necessarily as that it would be any similar to the previous iteration under the Trump administration. I can say that for our company, I've been on the Consumer Advisory Board under Director Cordray. We were part of the SABRIFA panel for the debt collection rule. We were in as tight a contact as appropriate with the research department, providing data, the anonymized data that we could provide. And of course, no one comes and says, yes, this is great and we're going to use it in this way, but you can absolutely see that the regulator was willing to let itself be convinced when there was a strong case for consumer protection and consumer preference that preceded what the industry wanted, right? You can't come and say, oh yeah, we'd like that because it's going to reduce our costs. That is not going to work. But if you have data to show consumers want this, they ask for it, they give you qualitative and quantitative feedback that this works, you're going to get a very positive response, in my opinion, in my experience. And we've seen that for our technology, and I think we're going to see that for other consumer protection areas. So from your perspective, I mean, you've known the Biden administration's candidate for director, Rohit Chopra, and others in the administration and the CFPB. How would you compare and contrast this coming CFPB, what it could look like? Of course, there's no certainty, and how it looked like when you were there.
Yeah, it's a good question. So I think, and you already sort of mentioned that. So the approach towards financial services or regulating or supervising financial services will be very different from what we went through in the last 3 years. So there definitely will be more scrutiny on certain industries, products and services. So if I may, so if you think about the y-axis probably is the consumer, right? The x-axis is the product. So what's the interaction or four quadrants? Which part of the this space that CFPB will take a lot of attention, will pay a lot of attention to? That is the products that are used by vulnerable consumers or subprime. Think about subprime lending, think about debt collection. When the FTC partnered with states and other federal agencies and launched an initiative called Operation Corrupt Collector. So that by the way, that was under the Trump administration. That was 2020. And that tells you, debt collection, especially today's, because this is the topic of today, naturally has always been attracting attention from regulators, state and the federal. And I think the scrutiny will be even more intense in the Biden administration, in the current CFPB. And I think at the end of the day, it is really, and Oha, you mentioned, just 5 minutes ago, 10 minutes ago, the CFPB announced the delay of the rules, and I think that's, I have always been thinking, since last November when we knew Biden will win the election. Well, at least some people believe he had won the election. I always think, a lot of the rules that were finalized in 2020 or 2019, they probably will be I wouldn't call it on the chopping blocks, but at least there will be some kind of revisit. And how much are they going to change? We don't know. But if you read the letter from Chairwoman Maxine Waters, House Financial Services Committee Maxine Waters to then President-elect Biden, she specifically asked, I think that question was in the letter. She specifically asked the Biden administration to revisit and change some of the provisions there. And not to mention, I think this was back in the Obama administration when the CFPB first embarked on the debt collection rulemaking agenda. They were thinking about, it was a much more ambitious, but later on in, I think about 2017, they decided, because of the resource issues, they decided to drop part of it and they just pursue, which is what the Trump CFPB did. So I think the first party debt collection probably will be back. I don't know how soon it will be. I think at least there's a 50% chance, or more than 50% of the chance it could be back. And I think more importantly, the CFPB will be really focusing on the accuracy of the data when the debts transferred from one buyer to another. And the consumers always claim that many consumers complain, and that's actually the biggest complaints from the CFPB's consumer complaints portal, that people were saying this is not my debt, or the amount is inaccurate. Yep. So I think from the rulemaking perspective, definitely there will be some kind of changes. But I think more importantly, I think for this audience, it's really the more immediate sort of impact is really the enforcement side. And the CFPB, frankly, to give the previous CFPB credit, they were not really sleeping on the wheel in terms of looking at the debt collection industry. I think according to the most recent report they submitted to Congress, the CFPB last year they had 4 enforcement cases in debt collection. I think FTC probably had more; they had 8 or something like that. They result in $15 million civil penalty and I think $80,000 consumer redress. So I think we'll see these numbers probably go up, and both in terms of civil penalties and the consumer redress. And just to go back to Oha, what you said, if you think about very prescriptive rules, think about the frequency, for example, frequency of contact. How many times can you call consumer within a week per debt? How many times can you email, text someone? Under what circumstances can you email or text? And what kind of consent should you get from consumers? I think these kind of things, I wouldn't call it easy to comply with. They definitely will take a lot of effort. But if you have a good consumer, CMS in place, you can do it, right? But I think what's really hard is the sort of the soft, the prescriptive part, which is how do you really help your customers, or how you actually hurt your customers. And this is really, and people always complain about UDAP, but UDAP is really a sort of catch-all. That's true, but also right. You cannot really, point a specific rule, prescriptive rule or provision in the rule that the company is violating, but you're actually saying your company is not treating your customers fairly. You're deceiving your customers, and that's where UDAP really comes in and it really can, catch a lot of people. And I think it's not just about, as you mentioned, it's not just about sort of the digital first approach, right? Mm-hmm. So using machine learning AI to really to make the debt collection more effective, but it's also more importantly, I think it's really think what your customers think, and then try to help them get out of the debt fast. And if they really cannot pay you, have some sympathy at least, right? And I'm not saying being sympathetic, you can win your customers, but at least that's a starting point. Fostering that kind of compliance culture, and then really using better technologies, better contact methods to make that collection more seamless, more frictionless, and more effective. And I think that's really a lot of the, unfortunately, a lot of the players are lacking, and as a result, they had a very nasty, knock on the door from the CFPB or from the other, federal state regulators.
Yeah, sure. And so I want to highlight 2 things that you said. One, just as a headline, I think it's a strong prediction. 50% chance you said of a first party FDCPA effort. Yeah, I know it's not based on actual data, but in this world of uncertainty, I agree with you. I mean, 50% is a high. I mean, maybe not, but it's not a definitely not. It's also not a definitely yes, but it's something that we need to consider. We've been hearing about the potential first party FDCPA for years now, and it may come. The other thing is enforcement, and we know that the prioritization of civil investigation demands, CIDs, and attention from enforcement and auditors is prioritized among other elements, by consumer complaints in the CFPB database. And going back to your point about how we treat consumers, look, we at TrueAccord, we build technology first. We think technology first and product first. We focus on empathy. We focus on user experience and net promoter score. If you're in collections, you may think that doesn't matter that much as long as you get paid. But the reality is that serving consumers the way they want to be served doesn't only result in more payments, it results in better reviews. And better reviews means less complaints. Less complaints means less attention from regulators. Forget, you may not be violating any rule, but definitely not intentionally, but you get a knock on the door from the regulator and they want to audit you. Under the best circumstances, it's a huge distraction. And so serving consumers well, it's beyond just being the good guy and hoping to get paid. You get paid more, but you also get potentially less attention from regulators because you get less complaints, you get less consumers on your case because they feel like they've been treated fairly. And it's an important thing to highlight. Last time you and I talked, when you came to talk to our company, you predicted that if Biden were elected, we would see much more collaboration between state AGs and the CFPB. Do you see that happening? Do you think that's going to really come to pass and kind of states working together with the federal regulator? We've seen that I believe in antitrust action in the past few months. Will we see that in financial services regulation?
I think so, yeah. I mean, I think it's just not the state AG, but also state banking supervisors, right? So they're not the same, but they obviously have been traditionally working. And I think if you look at the record of Director Cordray, his background was state AG in Ohio, so naturally he brought that kind of experience and expertise and the relationships, frankly, to his new job at the CFPB, ahead of the CFPB. So the CFPB traditionally is, especially under his watch, work very closely with the state AGs and state banking supervisors through CSBS a lot. And I'm not saying the Trump administration did a lousy job. I think the relationships have been maintained pretty well. But I think if we see an increased amount or activities of enforcement in the Biden era, I think we'll see more collaborations or cooperations between the CFPB and the state AGs and the state banking supervisors. So it's still in the early days. And the Rohit Chopra's, I think the consensus is that he's not going to get his his floor vote until probably in May, after his replacement on the FTC has been confirmed, because the Biden administration wants to have a Democratic majority on the FTC board before they let him go. So most likely he would probably join the CFPB in May, and it will take some time for him to really go through briefings, understand. I'm sure he's very up to date, but still, there will be some kind of reassessment of the priorities. And obviously we can talk about the priorities. Enforcement definitely is number one for sure, right? And also thinking about the rules that they're going to revisit or write new rules, or rules that are still in the pipeline. And I definitely believe working effectively with the states will actually add more power to the CFPB's already aggressive enforcement approach.
Yeah, absolutely. How are we doing on time?
All good, but I think this is a great moment to switch over to our lightning round. All right, so thank you so much, Ohad and Dan. You've given us a really great overview of the regulatory context right now, things that people should be paying attention to in the next couple of months. I really want to make sure that our audience today walks away with some concrete things to think about and to do as they're thinking about collections and compliance and even their own striving towards innovation this year. So I'm going to ask you some questions, and the goal here, we'll try to gamify it a little bit, is to answer as fast as possible within reason. You can take your time, but let's start with this. So also, I feel the need to give a bit of a caveat before we launch into this insight section, that no one on our speakers today are industry experts, but they're not lawyers and they don't work for any of your organizations. So your mileage may vary, but let's talk about actionable insights for this audience. So Ohad and Dan, what is one piece of advice you would give to a lending organization trying to increase repayment rates while remaining compliant this year? Ohad, let's start with you.
I would say historically in this industry, compliance, and I'm not sure it's compliant, has been an excuse, a little bit of a cop-out sometimes for more traditional organizations to stay away from using technology. It's time to embrace it, not only because of the new debt collection rules, but because the basis for how to use technology and debt collection has been laid out by the record first and by others a second, whether it's emails, texting, with the new ATDS definition from the Supreme Court. It's time to think about it, be thoughtful about it, but embrace technology and service consumers the way they want to be served. It's going to be a stretch for a lot of us, but this is why organizations like TrueAccord and others exist.
Amazing. Great. So embrace technology and think about technology in terms of consumer preference. Dan, anything to add there?
So I definitely agree with Oha. I think technology definitely should be the first one on their mind. And I'm amazed to see that it's really amazing that, when we think about, banking, we have, this new term called challenger banks or neobanks, digital banks. And but in debt collection, unfortunately, there has not been a sort of massive shift to new technology. And phone calls, obviously, still phone being the most prevalent method of debt collection, and I think that's what the CFPB's rule has been really focusing on. So definitely embracing new technology would be a very good start. And I think I also want to add to that, really thinking what your customers think. Put yourself in their shoes and really help them. And I think that's really, as I said earlier, it's really the start point, the beginning point of fostering a more compliant culture, and ultimately with the assistance of technology, you will do a better job in collecting those debts.
Great. Yeah, thank you so much. So yes, echoing focus on consumer preference and not being afraid of technology. Wanting to be compliant is not an excuse to default to traditional methods. Embrace technology and think about how you can use it to empower your consumers and figure out what their preferences are. All right. Great. Next question in our lightning round. What is, when you look at a lending organization or any kind of organization, fintech organization that is trying to improve their payment or collections processes, what is a common mistake that you've seen, and how would you recommend that lending organizations avoid it? Dan, let's start with you this time.
Well, actually, I think it's very simple. Don't lie to your customers. Don't deceive your customers. Don't threaten your customers. And you saw this these enforcement actions from the CFPB, from the FTC. It's all about debt parking, ghost debt, illegal threatening or false threatening claims. So I think these are the bad practices that no lender or debt collector should actually engage in the first place.
Great, very clear. Don't lie. Ohad, anything to add?
Yeah, from my perspective, a lot of times it feels like collections and recoveries are an afterthought. I think for some organizations, and I think a lot of the folks on this call would agree. When I look at fintech, that means that instead of thinking about how they service consumers, they end up selling debt. Nothing bad about selling debt to an established and reputable debt buyer, but you lose the relationship with the consumer and you lose the ability to regain their trust and regain them into your system. And a lot of times those decisions of, hey, let's just call more, hey, let's just sell the debt, and losing that relationship and sometimes putting yourself at risk are the result of not planning ahead. Consumers are going back to spending. There's going to be more credit. There's going to be more defaults, maybe not as percentage, but definitely as absolute numbers. And the time to prepare is now, not in 6 months.
Great. I love that. So common mistakes are how to fix common mistakes. Don't lie and focus on the consumer relationship. And the consumer relationship doesn't end just when someone is in debt. And think about how you can continually improve that relationship. All right, last question for our lightning round, and then we're going to move into Q&A. So just a reminder to everyone, you can submit your Q&A, your questions using the Q&A feature at the bottom of your Zoom window. All right, last question. So ultimately, everyone in today's audience wants to get better at helping consumers who are in debt or who are having financial difficulties. What's the first thing after this webinar ends, and in a few minutes, what's the first thing everyone in our audience should do to help accomplish this goal? Ohad, I'm going to throw it to you.
No,
Oh, Dan.
Can I go first? Yeah.
Yes, go for it.
Well, I'm half joking and half serious. Talk to Oha after this webinar. I've been I've known Oha for a long time, and when I was a regulator, now I'm no longer a regulator, so I see him as a friend, and I do think I do like what you guys have been doing, and I think one of the reasons I think Oha, you have been very effective. As you mentioned, you're willing to share information with the CFPB, really try to, obviously, from your perspective, you're trying to help grow your own business, but also from public policies perspective, that kind of data is really important. The data points that the agencies are otherwise unable to collect, I think that's really being very, very useful for the policy making and the making process. And I think that's kudos to you guys doing a good job in that space. But I think from the business perspective, I do think technology first approach is really must in the debt collection space. And we have seen the massive, as I mentioned earlier, massive adoption of digital technologies in other financial services space, but I think debt collection is really yet to be changed, for the better.
Great.
Oh, thanks, Dan. That's great. I would absolutely say go on our website and go through the benchmarking questionnaire, see how you rank versus the standards in the industry. Learn a little bit about that, and yeah, talk to our team because we're ready to work with you, and we'd love to do it. We're growing quickly. We have more than 6 million active accounts in our system. Almost 18 million accounts have gone through our system in general. That's a lot of data that allows us to understand consumer behavior and tweak our algorithms in our system to service consumers effectively. So yeah, absolutely. Benchmark first, and then see how we can help you.
Awesome. I'll follow up after the webinar today via email and send everyone the assessment on our website so you can begin to benchmark your own, your own collections practices. All right, we've got some great questions, so let's move into Q&A. So actually I want to start, someone is interested in hearing more about what to expect on a state level this year in terms of collections regulations. Yeah, Ohad, go for it.
Yeah, I can jump in. The thing I'm most excited about right now on the state level is the California regulators debt collection advisory board. I hope they're about to announce the people appointed to the board. I think that's going to be a very interesting body that's going to influence collection regulation. If you look at the CCPA and how it's affecting consumer privacy laws across the nation, California is one to watch.
Great, sounds good. All right, we have some great other questions. First one, what are your thoughts on financial education to help consumers prevent and manage debt?
So I can take that one.
Great.
I think it's very important. And in fact, if you look at one of the mandates of the CFPB, consumer education engagement is one of the things that CFPB has been focusing on since day one. And that function actually endured the last 3 years and diminished a little bit, but I think it will probably pick up speed and activities for the years and months to come. So really trying to help consumers understand debts and form a good habit, spending habit, and manage their financial lives better. In a better way, so not getting into trouble in the first place. But we should also be realistic that education can only do as much as you try or consumers try. At the end of the day, because circumstances, because individual differences, some consumers are going to get into debt. So believing consumer education is the sort of cure-all thing is not realistic. It definitely can help. It definitely can prevent. It's a proactive thing, but definitely, at the end of the day, we know some people are going to get into trouble because of their problems or because of circumstances, many times the circumstances. So it's really, I think the industry or debt collection industry is going to play a very important role for the years to come.
Great, yeah, thank you for that. Another question here, what are your thoughts on the use of social media for debt collection?
I think there are two ways to answer this. If we're thinking of social media as a way to just kind of, and Benjamin, I'm not saying it's what you're saying, but as a way to just annoy the consumer, get into their inbox, find ways to get their attention, I think that is risky. That is something that's going to get that is getting a lot of attention from the NCLC and others, and rightfully so, and feels like an invasion for consumers. There are ways to use social media in an effective way that draws the consumer's attention, is highly targeted, is highly personalized, does not expose that information to others. But you have to be very thoughtful about it and programmatic about it. This is not your average like agent friending people on Facebook. That is not a good idea.
I would agree 100%. Yeah, I think privacy concerns will really, jump out to me, and the reputation risk. I think it's not just for the consumer, but also for the companies that are engaging in those kind of behaviors. So I think definitely needs to be carefully thought through.
Great, thank you so much. All right, we have 2 more quick questions. I think we can do them both. So what is one piece of technology that you would recommend having in place now to be ahead of the compliance game this year?
Dan, do you want to take this, or I can take
No,
this?
I think you should take it.
Yeah, I think the industry is has made a lot of progress in the last few years, and if you're ready to take the leap, this is not a piece together from different vendors that's going to make your life hell. You should work with someone who knows what they're doing. TrueAccord is one of them, and just have someone who's done it at scale. I mean, we're at a point where we send 20+ million items of digital communications, email, text, and so on a month. That is a scale that allowed us we've made a lot of mistakes and learned from them. And I don't think you want to replicate that. Right? I don't think you want to start sending emails or text messages and start getting sent to spam inboxes and try to solve it on your own. Work with someone who's done it before.
Great, thanks. I think we have a couple more questions, but I think we really just have time for one more. Let's say, okay, one more question. What are your thoughts on the 7 calls max within 7 days in attempting to collect? Do you know when this will go into effect?
So I think we know the answer to the second question. At least there will be a 60-day freeze, right? Both Oha and I mentioned at the beginning of this call, of this webinar, that the CFPB just released that. On the 7 calls maximum per debt, I believe. So that's really a very contentious point. I think in the letter that I mentioned earlier from Chairwoman Maxine Waters to President-elect Biden, she really didn't like that. And a lot of consumer advocates are looking for a more stricter cap on the frequency. So again, goes back to sort of a common theme of this conversation. Phone call definitely has been traditionally the most prevalent method of debt collection, but think about other methods, more digital first approach, using technology-driven approach to collect that more effectively, more efficiently, and also putting consumers in the driver's seat, if you will.
Yeah,
Great.
and I would say when you use technology, you don't need 7 calls. We don't call almost at all, and that works well.
Great. Well, thank you so much to both of our speakers. There are 2 more questions, but in the interest of keeping things short today, we can follow up with those after the session. Thank you again for joining. It was such a pleasure. Thank you, Dan. Thank you, Ohad. So I learned a lot today, and we'll see you next time. Thank you for joining us, everyone.